Welcome to a captivating dive into the world of finance, focusing on the recent development in banking regulations. You may ask, what are banking regulations? Well, they are a form of government regulation, which subjects banks to certain requirements, restrictions, and guidelines. This is done primarily to maintain the integrity of the financial system and prevent any form of financial crisis. Now, let's touch on a recent development in this sphere. U.S. banking regulators have proposed an increase in bank capital requirements. Bank capital is the financial cushion that banks keep as a safeguard against any potential losses. This proposal aims to increase this cushion. A separate proposal is also on the table that seeks to raise a capital surcharge for the largest global banks. However, it's not all set in stone. The regulators have extended the comment window for these proposals, giving more time for interested parties to analyze and provide feedback. This extension is a vital part of the regulatory process, allowing for thorough examination and discussion. Stay tuned as we dissect this intriguing proposal and its potential impacts. First, let's explore the Basel Endgame proposal and its roots in the aftermath of the 2007 to 2009 financial crisis. This proposal, quite simply, is a reaction to the financial instability that we witnessed over a decade ago. It's a plan designed to ensure that banks are better prepared to weather future financial storms. So, let's break it down. The Basel Endgame proposal is all about capital standards. Now, what does that mean? Well, capital standards are essentially rules that determine how much capital a bank must hold in reserve. This reserve acts as a safety net, protecting the bank and its customers from unforeseen financial shocks. The more capital a bank has in reserve, the more resilient it is. The financial crisis of 2007 to 2009 highlighted a problem in these standards. Many banks didn't have enough capital to withstand the crisis, leading to a domino effect of bank failures around the globe. To prevent this from happening again, international banking authorities came together to agree on new, stricter capital standards. This is where the Basel Endgame proposal comes in. It's an attempt by U.S. banking regulators to implement these international standards. The proposal aims to raise the capital requirements for banks, particularly the largest global ones. This means that banks would need to hold more capital in reserve, making them more resilient in the face of financial shocks. However, it's not as simple as just raising the bar. The proposal is complex and has far-reaching implications for the banking sector. It's facing opposition from banks who argue that the increased capital requirements could limit their ability to lend and invest. Yet, proponents of the proposal argue that these stricter standards are necessary to protect the global financial system from future crises. They believe that the short-term pain of higher capital requirements will lead to long-term gain in the form of a more stable and resilient banking sector. Understanding this proposal is key to grasping the current banking scenario. It's a critical piece of the puzzle in the ongoing debate about how to best safeguard our financial system. Whether you're for or against it, the Basel Endgame proposal is undeniably shaping the future of banking. Now, let's delve into the opposition this proposal is facing and the potential impacts it could have. As with any significant change, the proposal to raise bank capital requirements is facing opposition, particularly from banks themselves. They argue that the heightened capital requirements could constrain their ability to lend, potentially stifling economic growth. This concern is not unfounded. Banks are the lifeblood of the economy, providing loans to businesses for expansion, to consumers for purchases, and to governments for public projects. If banks are required to hold more capital, they may have less to lend, which could potentially slow down economic activity. But it's not just about lending. Higher capital requirements could also impact banks' profitability. More capital means less leverage, and less leverage often means lower returns on equity. This could lead to lower share prices and potentially even job losses in the banking sector. These are serious concerns, and they underscore the delicate balance regulators must strike between ensuring the stability of the financial system and supporting economic growth. It's a tricky tightrope to walk, and it's why the Federal Reserve is seeking additional data from the affected banks. They want to understand the potential impacts better before making any final decisions. However, it's also important to remember the reason behind the proposal: financial stability. The 2007 to 2009 financial crisis showed us the dangers of undercapitalized banks. When banks don't have enough capital to absorb losses, it can lead to financial instability and even economic collapse. The proposed capital hikes are designed to prevent such a scenario from happening again. So, while the opposition from banks is understandable, it's also crucial to consider the broader goal of financial stability. Yes, the proposal could lead to some short-term pain for banks, but the hope is that it will lead to long-term gain for the economy as a whole. The opposition and potential impacts underline the complexity of implementing such a proposal. Lastly, let's look at the bigger picture and the role of the Federal Reserve in this scenario. The Federal Reserve, often seen as the gatekeeper of the U.S. financial system, has a crucial part to play in this unfolding drama. In light of the proposed capital hikes, the Fed is actively soliciting additional data from banks that may be affected. This isn't just an exercise in bureaucracy. It's a crucial step towards understanding the real-world implications of these proposals, illuminating potential roadblocks and unforeseen consequences. Now, these capital requirement proposals aren't standalone measures. They are integral parts of a larger global effort to fortify the banking system. This effort, born from the ashes of the 2007 to 2009 financial crisis, is a long-term commitment to financial stability. The Basel Endgame proposal, as it's known, is an international agreement to set capital standards that can withstand future financial shocks. In this grand scheme of things, the Federal Reserve's role extends beyond mere regulation. As the central bank of the United States, the Fed is responsible for instilling confidence in the financial system. Its actions and decisions, such as the current proposal, directly affect the stability and integrity of the banking sector. However, the path to financial stability isn't without opposition or challenges. Banks, understandably, have reservations about the proposed capital hikes. Increased capital requirements mean less profit in the short term. But remember, the focus here is on the long-term health and resilience of the banking system. To wrap it up, the Federal Reserve's actions are part of an ongoing dialogue between regulators and banks. This dialogue is aimed at balancing the need for a robust banking system with the realities of business profitability. So, while it may seem like a tug of war at times, it's all part of a bigger plan for financial stability. This proposal is a significant piece of the complex puzzle that is banking regulation. In conclusion, the world of banking regulations is a complex and intriguing one. We've navigated through the Basel Endgame proposal, an international effort to stabilize the financial landscape post the financial crisis of 2007 to 2009. We've also peered into the role of the U.S. Federal Reserve as it extends its hand for more data to better understand the impacts of proposed capital hikes. With opposition from banks and a myriad of impacts to consider, the path to stronger banking regulations is a winding one. Thank you for joining us on this fascinating journey through the world of banking regulations. Keep exploring, keep learning.